Welcome back. In this section, we're exploring staking as well as going into some more detail on liquidity pools and yield farming. By the end of this lecture, you'll understand staking, how liquidity pools function, what yield farming entails, and the risks and rewards associated with these activities. I'll also try to draw some parallels to traditional finance to help clarify these concepts as we go. To kick things off, let's discuss staking. In traditional finance, you might think of staking as similar to investing in a certificate of deposit, where you lock your money for a fixed period of time to earn some interest. In DeFi, staking works by locking up your assets to support the operations of a blockchain network. Essentially, you lock up your assets in the network to help validate transactions and maintain that network security. In return for staking your assets, you'll earn some rewards, typically in the form of additional tokens. The revenue from staking comes from two primary sources. Firstly, you have transaction fees generated on the network. These fees are paid by users who execute transactions on the blockchain and are then distributed among stakers. And then you also have inflationary rewards, where blockchain networks issue new tokens as a staking reward to incentivize participation and maintain that network security. Some staking platforms also allow you to compound your earnings by automatically restaking your rewards, further increasing your potential returns over time. This process can be directly managed by yourself or through a staking service provider that offers custodial and management services, but for a fee. Consider staking on Ethereum. You'll need a minimum of 32 ETH to become a validator. By staking your ETH, you help secure the Ethereum network and in return earn ETH as a reward. This can either be done solo, where you provide all the ETH yourself, and then you can either run the node or use a provider to run that node for you. Or if you have less than 32 ETH, there are pooling services where you can stake with other people and earn a percentage of that total reward. While staking offers several benefits, it is important to understand the associated risks and manage them effectively. So in terms of benefits, staking can provide passive income, a steady stream of income, which makes it an attractive strategy for enhancing portfolio performance without having too much active management of your assets. It can also provide compounding returns depending on what asset you're staking, and that can obviously significantly increase your overall returns over time through the power of compounding. Things to be aware of, however, are the different lockup periods. So, staked assets are often locked up for a specified period of time, during which they can't be withdrawn or traded. So, this lack of liquidity can be a risk if market conditions change rapidly, which is obviously quite frequent in this industry. The other thing to be aware of is slashing. So, some networks penalize validators for malicious behaviors or technical failures, which can then result in a loss of staked assets. Normally, not all of them, just a little bit off the top. But it is crucial to be aware of this and to choose reputable staking providers if you're going to be going through that road. Now let's take a look at liquidity pools. We covered these briefly in the previous video, but now we'll look at them from the perspective of a revenue generating opportunity. So to quickly recap, liquidity pools are collections of funds locked in a smart contract that are used to facilitate trading on decentralized exchanges. These pools provide the liquidity necessary for users to trade assets without relying on a centralized intermediary. Think of it as a communal pot of money that traders can use to buy and sell assets, similar to how a traditional exchange relies on market makers to provide this liquidity. In return, liquidity providers receive rewards. This not only incentivizes the use of DeFi platforms, but also ensures that there is a sufficient liquidity for trading activity, which is crucial for the smooth operation of these platforms. Here's another diagram demonstrating how liquidity pools work, but coming at it from a lender's perspective. So say you allocate 100 grand to a liquidity pool on Uniswap, specifically the ETH USDC trading pair. That would require you to deposit 50k worth of ETH and USDC each. This action provides liquidity to the pool, enabling smoother trading activities on the platform. In exchange for this contribution, you'll receive LP tokens, representing your share of that liquidity pool. These tokens are proof of your investment and entitle you to a portion of the trading fees generated by that pool. When traders use the pool to swap tokens, they'll pay a small fee, which is then distributed to the liquidity providers as a reward for the participation. In addition to transaction fees, platforms such as Uniswap distributes additional rewards in the form of Uni tokens, which is its native governance token. These rewards are distributed to liquidity providers as an incentive for contributing to that pool. There are further levels of complexity that can then be built on top of this process. So, for example, to maximize your returns, you can then decide to take your LP and your Uni tokens and then stake them in another yield farm on Uniswap. This process is known as yield farming, which is effectively a broad term for combining different DeFi operations and staking to increase returns or yield farm. This allows you to earn even more rewards, creating a compounding effect on your returns, but does have some additional risks. So, what are the pros and cons? Liquidity mining can offer attractive returns, making it an appealing strategy to enhance portfolio performance. Participating in liquidity pools and staking opportunities can also help diversify income streams and reduce reliance on traditional markets. But it is important to note that yield farming comes with its own set of risks. So there's something called impermanent loss, which occurs when the value of the deposited assets change compared to when they were first deposited, potentially leading to lower returns. That's what's being shown in the diagram to the right here. To mitigate impermanent loss, you can choose stablecoin pools, which obviously have a much reduced price volatility. You can just simply monitor the market conditions and adjust liquidity positions during these periods of high volatility. Or some DeFi platforms also even offer permanent loss protection mechanisms, which reimburse liquidity providers for any losses incurred due to these price fluctuations. And then, as discussed, all these DeFi protocols rely on smart contracts, which can have vulnerabilities. So, therefore, it's crucial to conduct thorough due diligence and choose reputable platforms to mitigate these risks when you're participating in liquidity providing. So, to finish this up, I'm just going to quickly talk about margin trading. In traditional finance, margin trading allows investors to borrow money to increase their investment position, which can amplify both gains and losses. Margin trading in DeFi works in a similar way, but uses cryptocurrency as collateral. In DeFi, platforms like Aave and Compound enable margin trading through smart contracts. Users deposit crypto as collateral to borrow other assets. For example, you might deposit ETH to borrow USDC. The borrowed funds can then be used to buy more of the collateral or other assets, effectively increasing your exposure. If the value of the collateral falls below a certain threshold, the smart contract will automatically liquidate the collateral to repay the loan. This helps manage risk, but can lead to losses if the market moves against you. So, as an example, let's suppose you deposit 10 ETH at $4,000 each, making your collateral worth $40,000. Aave would then let you borrow up to 75% of this value, so you could borrow up to then an additional $30,000 of USDC. You could then use this USDC to buy more ETH, and if the price of ETH rises, your gains are amplified. However, if the price of ETH falls, your positions could be liquidated to cover that loan. In summary, margin trading, liquidity mining, and staking are advanced DeFi techniques that can enhance your investment strategy. Understanding these strategies and their associated risks can help you make informed decisions and optimize your investments in the DeFi space.